More on the markets. Let's bring in CNBC contributor Peter Boockvar, Chief Investment Officer at One Point BFG Wealth Partners. Peter, great to have you with us. What does it look like? How bad is it in your view if they, quote unquote, lose control of where the yen is going and where JGB yields are going in terms of not just the carry trade, but also, as Guy had alluded to, the money that Japanese investors have invested directly in other assets around the world? And that's a lot of it is U.S. Treasuries.
Well, it certainly matters from a flow perspective. I do think that a further rise in long-term interest rates in Japan can be sort of a magnet and drag higher long-term interest rates in Europe and the U.S. I know there's a lot of focus on Japan, but look at European bond yields. The ECB has cut the short rate by 200 basis points, and German, French yields are at multi-year highs. So I do think that there is a global, just as there was a global bond bull market, I do think that there's going to be a global pull upwards in yields if JGB yields continue higher. I think one interesting thing also with Japan and the yen is one of the cheapest currencies in the world versus the US dollar. But it can maintain that cheapness, or maybe it reverses. I think an important other currency to keep our eye on here is the Chinese yuan, which is quietly at the highest level since May 2023 against the US dollar. Chinese yuan doesn't rally like that for no reason. It is a purposeful rise, and if the Chinese yuan can rally, it can give room for the yen to rally and other Asian currencies to rally. Therefore, this dollar weakness, which I think is going to continue, could really broaden out amongst a variety of different currencies. And with so much foreign ownership of U.S. assets, foreigners are going to have two choices. Am I going to hedge up my dollar holdings, or am I going to start selling my dollar holdings, or at least buy less of them?
Peter, it's interesting. What point does dollar weak? It's historically a tailwind for U.S. equities. I get it. At what point, in your opinion, is it become a headwind? And maybe not in the form of dollar yen because it's its own animal, but dollar euros at levels we haven't seen in a while. I think it's headed to 125. I don't know I think I know what it means, but what do you think it means?
Well, and dollar pound, dollar Aussie, the Singapore dollar closed today at a 12-year high against the U.S. dollar. I know we think, okay, it's good for exporters, but the U.S. imports about 40%, or I should say 40% of U.S. imports are intermediate term goods that find their way into finished products. So on one hand, the final retail price could benefit from a weaker dollar, but almost half of your input costs are going to go higher. And also, we're dealing with a consumer that's dealing with PTSD on inflation. We've thrown tariffs at them. If you start to get a further weakness in the dollar, which negatively impacts their purchasing power, well, that can then be a drag on consumer spending, which we know is a huge chunk of the U.S. economy.
Hey, Peter, it's Karen. Thanks for being on. The flip side, though, to the weaker dollar for the U.S. is obviously we've got a huge amount of debt, and that's helpful. How do you think that plays into it at all?
Well, foreigners still hold about 30% of the U.S. Treasury market. While that's down from 50% about 10 plus years ago, they still hold about 30%. If that continues to go down, well, then the U.S. Treasury is going to have to find other investors, whether it's U.S. retail, U.S. institutional, stable coins, or whatever. So I do think that because of that very large ownership of U.S. bonds and stocks from foreigners, further weakness in the dollar could sort of disrupt those flows. And if we do get a joining of this industrial and precious metal bull market with oil because of a weaker dollar, well, then that complicates the inflation story. It complicates the job of the Fed as well.
Peter, Tim, yeah, and foreigners who've been hedging a lot of this dollar exposure may decide not to do that, and I think this favors international markets, but I've said that before. But how about the commodity space and the weaker dollar and the commodities that we're not thinking about? And we've been talking around here recently, and I know you talk about this too, that the prices in energy equities, forget valuation, but how they've held in during a period with the prospect of supply is just a sign that the market is telling you something. A weaker dollar tells you commodities always go higher and could go a lot higher. And I'm not just talking about gold and copper. I'm talking about the entire commodity chain, but oil for sure, where I think it's underpriced.
I agree. I think oil, and we've seen this huge spike in natural gas. We'll see where prices settle out at when this cold spell is over with. And I think it's going to eventually be joined by ag as well. There's no doubt that precious metals are very extended and need a timeout. You can say the same about copper as well. But I do think that it's a commodity bull market, and I do think it's going to spread out. And to my point earlier, if this does happen, if oil, instead of being at 60, is all of a sudden at 70 or 80, and natural gas prices remain above 5, it does become a very complicated story for the new Fed chair. And also, in addition to JGB yields, help to lift long-term interest rates.